Good day everybody, I trust that you are well. The purpose of this video is just to quickly run you through my record of advice with regards to your investment in Britannic Opportunities Ltd. Carly will email this document to you. From a need determined point of view, I've put there diversification against the Rand and South Africa, offshore investment in hard currency, as this investment will be done in US dollars, exposure to offshore equities, as your upside will have exposure to the S&P 500, the Nikkei 225 and the Euro Stoxx 50, 5-year plus time horizon. Even though the investment is only for 3.8 years, this is the long-term money of your portfolio that we are investing in Britannic. So I've put you there 5-year plus time horizon with no income requirement, principal preservation, inflation beating returns in hard currency. Products recommended, I considered direct investments versus flexible investments or offshore endowments, and under both A and B I considered unit trusts, listed shares, ETFs and structured products. So as far as the product that I recommend is concerned, I recommend that you invest directly in Britannic Opportunities, which is a direct investment, which is basically option A. And you can do this either by way of asset swap, if you're doing it in the name of a trust or a company, or if you're not utilizing your foreign investment allowance. So there are some of you that's going to invest via asset swap, so that will be crossed out. For those of you that are only using your R1,000,000, it will say by way of single discretionary allowance, and for those of you that are taking more than 10 million, it will basically say single discretionary allowance and foreign investment allowance. Reason for my recommendation, then I say please refer to annexures A to F, and we're going to go through that briefly. These are the ones that I have gone through with you individually, and I've just put there a note that you're comfortable with First Rand and ABSA sub-debt credit risk. Client decision, implement recommendations as proposed. Mine will have a signature there, your name will be there, you are required to sign there. If you married in community of property, both you and your spouse's details will be there, and both of you have to sign there. So let's just I'm going to skip Annexure 1 because that's pertaining to existing clients, and this video that I'm making is for new and existing clients. So I'm going to start with the new clients, and let's start with Annexure B. So this is just a summary in layman's terms. It gives you the opportunity to invest 40% in the S&P 500, 30% in the Nikkei 225, 30% in the Euro Stoxx 50. In other words, 100% offshore equity, but without taking equity risk. What we mean by that, the market risk has been hedged out. So just to recap, you invest in a company that's incorporated in Guernsey, which is listed in Bermuda. So it's governed in 3 jurisdictions, South Africa, Guernsey and Bermuda. It has an independent board of directors, and the company gets audited by independent auditors on an annual basis, which is available to all shareholders. So those of you that have been in Britannic for the last 5 years would know that the audited financials is available on Praxis's website every year. Just to recap, the Guernsey company, namely Britannic, then only invests in 2 assets on day one, which is a bond. In this case, it will be the First Rand and the ABSA sub-debt bond, and a call option. So what I mean by that is this is a passive investment. So there's no active calls that gets made during the investment term, and because the share is listed, you get daily pricing on the share as on any other listed share, and the daily value of the share is the daily value of the bond plus the daily value of the call option plus whatever cash is sitting in the company. Your capital is guaranteed at the end of the 3.8-year term. The cost of the investment is very, very low, as all expenses have been built into the par value of the share. So your capital is guaranteed net of all fees, and Investec therefore won't levy any additional charges during the investment term. You will remember that this equates to 1.33% per annum, the costs in total that has been built into the par value of the share. It's a very tax efficient structure, as at the end of the investment term you can lock in your growth without selling your share, and this is a very unique feature. Some of you that are invested in some of the other Guernsey Incorporated Bermuda listed companies that have already locked in your profits would know that this is a great benefit. The structure therefore allows you to lock in your profits every 3 to 5 years without triggering a tax event. Why is this? It's because you own the listed share and you do not own the bond directly or the call option directly that can attract income tax or capital gains tax. So the Guernsey company owns the bond that accrues the interest and the call option that will attract the capital gains tax. But because there is no corporate tax in Guernsey and Britannic Opportunities is not a controlled foreign company, the company also does not pay any tax in Guernsey. So the Guernsey company makes the profit, and there's no tax on the profits in Guernsey. So that is how you can lock in the growth every 5 years without triggering a tax event. From a risk perspective, you take counterparty and credit risk on the issuer of the subdebt. In this case, it will be ABSA and FirstRand, as they are the parties that are guaranteeing your capital at the end of the investment term. So let's just look at the mitigating factors. Subordinate debt ranks third in the queue when it comes to potentially losing your money. See the capital structure below. First ordinary shareholders, and then preference shareholders, then subordinate debt holders, then bond holders, and then deposit holders. So when it comes to losing your money, the ordinary shareholders of the FirstRand and ABSA shares, so the people that own FirstRand and ABSA listed shares, have to write down the total share capital down to 0. Then the preference shareholders would have to write down everything to 0, and only then will we stand a chance of losing any money. So if we put some figures to that, currently FirstRand's market cap is 346 billion, ABSA is 134 billion. If you add those together, 480 billion. So both FirstRand and ABSA's total share capital with a combined value of 418 billion would have to be written down to 0 before the preference shareholders will have to take a haircut, and only then do we stand a chance of taking a haircut. Here I've just shown you from ShareNet's website where I got those market caps from. This is FirstRand's market cap, and this is ABSA's market cap. If we then look at the issuer of the call option, which is unknown at this stage, it will be one of the top 15 global investment banks with a minimum international S&P A rating or better. So they will be paying the profit to us. So you also take risk on the option provider, as they need to pay us the profit. The mitigating factor there is any one of these 15 banks will have a better credit rating than any of the local banks. So that should give you some comfort. And then for new investors coming in that are converting rands to dollars, you have a currency risk, as this investment is in US dollars. And what we mean by this is that the rand could strengthen in the short term versus the US dollar. Remember, when we invest offshore, we measure in hard currency, so we want to beat inflation in US dollars. US inflation is currently sitting at about 1.6%. So this investment can give you up to 8% in dollars per annum, depending on the performance of the 3 underlying indices. Annexure C is basically just the attachment that I sent to you with the email, which just shows you the FirstRand and the ABSA bonds, the quantum in total, 500 million US dollars, 400 million US dollars was issued by ABSA and FirstRand respectively, and those were the yields that the bonds were issued at. You will see that it was issued last year already, and the first call date is 5 years from date of issuance, which is basically 3.8 years from where we are now. Hence the term is 3.8 years. This was just a summary on which companies make up FirstRand, and the highlights of the executive summary of the financial highlights and Basel III ratios. And again, the same for ABSA, financial information, Basel III ratios. If we then move on to Annexure D, Annexure D was just the fact sheet on the MSCI World. Remember, the 3 indices that we are investing in has got a 97% correlation to the MSCI World. So this is just where I explained to you that markets doesn't go up in a straight line. They can have positive and negative years. As you can see, in green highlighted was the positive years, and in yellow highlighted is the negative years. What we were interested in is to have a look at the 31.5-year average, which basically indicated that the MSCI World yielded a 7.93% return on average. Hence, we said the 8% that we can get is a very decent return. Is that because that is what global equity markets have yielded over the last 31.5 years. And just to refresh your memory, the MSCI World is 23 developed markets with 1,636 shares making up this indice. Remember, we're only going to be owning 775 shares. But the correlation between the 775 shares and the 1,636 shares is 97%. So if we look at these figures, over the last 10 years, the MSCI World has grown by 12.2% per annum. So it's been, relative to the long-term average, a very good 10 years, and therefore the opinion is that going forward over the next couple of years, markets will not experience the same 10 years as the previous 10-year bull market that we have experienced. And this was also just to show you what will be the top 10 shares that you will be owning, all the familiar names that you know, which makes up about 12.8% of the index. If we move on to Annexure E and Annexure F, these are Investec's official marketing documents. I have emailed this to you in a PDF format. I've also sent you a link to the video that I've made in which I give you my comments on these two documents, Annexure E and Annexure F. If you haven't received the link as yet, you can just send me a WhatsApp and I'll forward the link to you. It's basically just an 18-minute video where I cover Annexure E and Annexure F in detail. So for those of you that are new investors, you can stop watching the video now. For those of you that have been in Britannic over the last 5 years, I'm just quickly going to run through Annexure A just to quickly recap. What is the difference between the share that over the last 5 years versus what I refer to as phase 2, which will be now when new investors come in and until April 2023. So previously we had downside protection, 100% downside protection in pounds. This is now going to shift to 100% downside protection in US dollars at maturity. The credit risk that we took on the issue of the bond was Investec. This is now going to shift to First Rand and ABSA. And I just said the C organizational structure, Annexure C, which is basically that one that I've just gone through. From an ownership perspective, it remains exactly the same. We own the sub-debt of Investec. Now we're going to be owning the sub-debt bond of First Rand and ABSA. And I say C capital structure. With that, I'm referring to Annexure B, which is this little capital structure that I've inserted there for you. Then if we have a look at the currency risk, I've skipped one. Credit risk on the counterparty on the equity option. The issuer of the option was JP Morgan, 40.25%, and BNP Paribas, 59.75%. As you know, just like we didn't know back then who was going to be providing the option, we don't know yet, but it will be one of the top 15 global investment banks with the S&P A rating or better. The currency risk that we took was Rand versus pounds because this investment was in pounds. This investment is now shifting on the 8th of July to US dollars. So your pounds is going to be converted to dollars, and the investment will be made in dollars, even though you're going to remain or keep your shares in pounds. Then from a gearing perspective, this, as you know, was a digital return. We are going to be receiving 38% in pounds, even though the market has only done 7.69%, which is absolutely phenomenal. We're receiving 5 times what the market has yielded over the last 5 years. Going forward, it's changing from a digital to a 200% participation. What that basically means, is we can go through it in a little bit more detail down here, is that the outperformance between 18.5 and 3 times 2 plus the guaranteed 3% that we've been getting is what you can expect to receive. So if we move to the minimum return, here only 100% of what you put in was guaranteed. The minimum return, they're guaranteeing a minimum 3% return in dollars. This is just to compensate new investors that are currently sitting in cash in dollars, so that they won't be any worse off from a return perspective investing in Britannic as opposed to keeping the money in cash if markets were to fall from current levels. So at least a minimum 3% return in dollars to compensate you for what you would have received had you remained in cash for the next 3.8 years in dollars. Return cap, on this side we had an uncapped return. That just basically meant that if the FTSE 100 yielded more than 38, if it did 40 or 50, we received 1%, 1-to-1 on the upside. So that's why it was uncapped. This investment is capped at 34% in US dollars, and I refer to see page 2 of the frequently asked questions. In other words, what does the 34% equate to? It equates to a maximum of 8.1% per annum in US dollars. If we have a look at the indices, we were 100% linked to the FTSE 100. Now we're spreading it a bit wider. We will be owning these 775 shares in the weightings, which I've covered in Annexure B. The term of the investment is 5 years. This has come down to 3.8 years, and I've put a theoretical 8.78 years. Remember, the first call date of the bond is in 3.8 years, but hypothetically speaking, if for some reason the Reserve Bank doesn't allow FirstRand or other ABSA to call the bonds, it will run to maturity, which will mean it's a further 5 years, and that's how we get to the 8.78 years. I put there theoretical, is in my opinion it's close to 0.01% that will happen, because companies won't be able to pay dividends if they haven't honored their debt obligations. If you have a look at the company's Basel ratios, they're well above where they should be. So I can't foresee any reason for the Reserve Bank prohibiting either FirstRand or ABSA from calling the bonds. And even if they do, you will be receiving the 6.25, let me just quickly go there, the 6.3 and the 6.2% return in dollars, because that is the interest that is gets paid on the bond. And the profit of the option will then just be dividend paid out via dividend after 3.8 years. So even though it's a very, very low probability, still a good return should that scenario play out. At maturity, we are now receiving our 38% in pounds, because the market only did 7.9. At maturity, at the new investment, we'll get the guaranteed 3 in dollars plus whatever the growth was, if there was any growth, with a weighted movement of indices at 200% participation capped at the 34, and they are just referred to page 3 of the brochure and page 2 of the frequently asked questions. So page 3 of the brochure and page 2 of the frequently asked questions, which is Annexure E and Annexure F respectively. If you keep it at maturity, like you are currently doing now, we're going to lock in the growth without triggering any tax events, so that remains exactly the same. And should you decide to sell the share, capital gains tax will be applicable. And remember, you only pay capital gains tax on the hard currency growth. So whatever you invested in pounds on day one, that's your base cost, and whatever you're going to sell at in future, which will be US dollars converted back to pounds, and that will be your market value on that day, and then you only pay tax on whatever the growth was in pounds. And you can either use the spot rate, in other words the rate at that day, or you can use the average of the last 1 year's rand versus pounds exchange rate. And then I just put there times your marginal rate, times your inclusion rate, your marginal tax rate, anything between 18 and 45, times your inclusion rate, that's a fixed 40%. In other words, you're going to pay capital gains tax a minimum of 7.2 and a maximum of 18%, less your annual exclusions. I see I made a spelling error there. Apologies for that. That should be an E. Carly, if you can fix that for me before you send it out, I would appreciate it. Which is your 40,000 rand per annum. So that remains exactly the same. For those of you that are putting more money in, you will be subscribing to the Class B shares, which will be the US dollar shares, the same as any new investors coming in. They will also be subscribing to the Class B shares, which is US dollars. So everything remains exactly the same. It's just your hard currency growth in dollars converted back to rands at either the spot or the average rate, times your marginal rate, times your inclusion rate, less your annual exclusions. I see there I spelled it correctly. And that is that. If you have any questions regarding this, you're only required to sign the first page of each document. And if you have any questions, please do not hesitate to contact me. Thank you and have a great day. Cheers. Bye.